Thank you very much. At the outset, I would like to express my gratitude to the organizers for giving me the opportunity to listen to such distinguished scholars. I would like to make a few points in regard to the global financial architecture. As many of the discussions with regard to the global financial regulation, etc., are based on the observation that globalization of finance was sort of ahead of the globalization of regulation, and therefore there are efforts to bring about some sort of a global agreement in regulation. Perhaps we could argue that if we had a globalized framework of financial regulation about 5 or 7 years ago, then India, China would have followed the same global financial sector regulation. So my submission is there merit in diversity of public policies in different parts of the world? There is another reason why we may have to look at this, that the counter-cyclical regulation requires some harmonization with monetary policy, some harmonization with fiscal policy. So harmonization between fiscal policy, monetary policy, and financial sector regulation may have to address a lot more the domestic trade cycles. So then how does that fit in with an open capital account and a globalized financial regulation? So the one thought I would like to give is there a case for more diversity in the global financial regulation? Second, where did the problem arise in the world? Essentially, it arose perhaps in two or three important centers where there was soft regulation. So if the problem was essentially soft regulation in 2 or 3 jurisdictions, the logical solution is that you should prescribe minimum regulation for all countries, not necessarily same regulation for all countries. So this way you can reconcile. And if there is a price to be paid by a country which is having a more rigorous regulation, that's for the country to pay the price, but it's not exactly affecting the totality of the picture. But that's a second thought that I would like to leave with you. The third, I'm trying to make a case for a slightly redefined approach to global financial sector regulation. The third, if we leave the regulation as much as possible and prescribe a minimum regulation in different jurisdictions, then the question arises, how about the global finance or the global banks? Perhaps it will be useful to make a distinction between multinational banks and international banks. Multinational banks operate in different countries, but they essentially operate in the domestic jurisdictions, essentially in the domestic currency. The international banks operate or concentrate on cross-border. It is possible that these international banks, as part of financial conglomerates, are in a privileged position for several reasons, and they generally operate from jurisdictions with soft regulation. First, they arbitrage between different sets of regulations in different jurisdictions. Second, simultaneously they operate between different sectors of the financial market. Third, they conduct their operations across tax regimes. Fourth, they are able to operate at different levels of formal legality in different jurisdictions. In other words, if there is a concern of public policy in regard to large bank balances in some jurisdictions with inadequate transparency, the money could not reach such jurisdictions or such places without the active involvement of international banks. And therefore, it can be argued that if there is to be a highly intensive regulation from a global angle, it should really be concentrating on those banks which are operating as quote-unquote international banks or substantially operating on cross-border jurisdictions. Therefore, in sum, my submission is that the regulation of financial sector should essentially be the responsibility of the national authorities, and every effort should be made to ensure that they serve the national interest but in the process ensure that there are no serious risks for the rest of the global economy. 2. In order to avoid the risks of soft regulation and the global economy, minimum standards of regulation could be prescribed for all countries. 3. A degree of diversity consistent with the institutional as well as socio-economic context of different countries and different regions should be consciously encouraged. 4th, scope for counterbalancing and decentralization of the global level institutions to bring about a better balance between stability and efficiency could be explored in parallel with reforming existing global level institutions. In other words, while the IMF could be there, IMF could still sort of become overall a federating, an umbrella organization, and still encourage the regional level institutions. That will also provide for a certain amount of decentralization. And as I mentioned, there is need to concentrate on international institutions. Is there a possible analytical framework for this approach? Yes, I believe there is. This is found in Professor Stiglitz's recent paper, Risk and Global Economic Architecture, Why Full Financial Integration May Be Undesirable. This is the paper, NBR working paper, February 2010. The paper provides a general analytic framework within which the optimal degree and form of financial integration could be analyzed. The paper indicates that full integration is not, in general, optimal. The paper identifies the problem relating to risks as one relating to the contagion which should be contained through well-designed networks, such as imposition of capital controls. But however, it can be argued, and he argues in favor of circuit breakers, but my submission is that the circuit breakers are not mounted after the event. The circuit breakers are put in position in the system. That's number one. Second, the circuit breakers operate in what was mentioned as in a given physical situation. It doesn't involve as much of human dynamics as the financial sector involves. And third, of course, is that it may be needed to calibrate the circuit breakers when human behavior is involved. So that's a slight modification I would suggest to what Professor Stiglitz has referred. Second, he has refers to the fact that the world is rife with non-convexities, and hence global integration based on assumption of convexity may not be desirable. So in this regard, he refers to externalities such as bankruptcy and information costs. Now here again, it can be argued that international banks and financial conglomerates may have the capacity to inject information cost and inject complexity. Professor Stiglitz adds that, quote, simulations within a variant of our model show that an appropriately designed circuit program can be welfare enhancing. But it may be useful to examine whether the appropriate mechanism for financial market should be only a circuit breaker or a voltage stabilizer also, or both. In conclusion, further debates to global financial architecture should be based on questioning of fundamental assumptions behind the risks and benefits of deregulation and liberalization of financial sector that had been the foundation of our economic thinking in recent years. In brief, I believe the way ahead, and particularly due to the emerging uncertainties in the global economy, there is considerable merit in emphasizing on policy autonomy, policy space for many of the countries. Thank you very much.